I want to pick that up and go to my friend Keith Fitz-Gerald. Keith, with that in mind, I mean, what Joanna is saying, it's logical. At some point, we'll get our arms around this. At some point, it won't disrupt our day-to-day lives to the degree that it is. We won't be necessarily dealing with mandates and restrictions and masks and anything else. We'll go outside, we'll live. With that in mind, should investors just assume it will be over at some point and focus on a post-COVID portfolio right now?
I think that's exactly what they should be doing. Waiting until the game is clear is too late. History is exceptionally poignant on this. So a company like JP Morgan, for example, is ideal. Everybody thinks it's going to go down when the Fed pressures it or rates goes, but that's really the kind of company that's going to help the world survive when we do go back out and we come out of hibernation.
Jack, let me bring you in here. The 10-year yield keeps going down. He had already erased the gains, that big spike we saw after the August 6th jobs report. Invariably, almost everyone, all the experts that I ask keep telling me it's not a big deal that we're going back down. But we did bounce off a technical double bottom. And if we get back to that level or even lower, should we pay attention? What would the message be?
Yeah, I mean, I think we've seen a pretty dramatic turn of events, if you will, since the Fed's last meeting, largely on this on the Delta spike, but also in China. I mean, and they're locking down. They've had floods. They've got manufacturing disruptions. They're cracking down on their largest companies. They are not the growth engine that they once were, and I think investors are beginning to realize that. And so I think that based on what we saw from the Fed minutes from July, I think a lot has changed. I mean, notwithstanding this Afghanistan debacle. And so I do think that we have to look for a little more slowing here and not the benefit of fiscal spending.
Let me pick up on the Afghanistan thing. It's tough to draw a direct line to the economy per se, right? They're not a major oil producer. But I think there is something to the way this is falling out, to the malaise factor there, that exacerbates or magnifies any bad news, Jack. So a day where the market might have been off 1%, we might be off 1.5%. I mean, do you feel that there could be that kind of a connection there?
I think there's actually a more solid connection, Charles. I think that, the fact is that, President Biden was teeing up roughly a $1 trillion infrastructure package on top of a $3.5 trillion budget reconciliation program. And I think his political capital is virtually evaporated. And the possibility now that legislation navigates its way through Congress is diminished. And I think the Fed was counting on a lot of fiscal check writing to offset some of this bond buying. So I think there is a new calculation that's going on.
Keith, I saw this morning you tweeted something to the effect, scared money don't make money, something like that. Am I to assume that you were buying this dip this morning?
Well, first of all, thanks for reading along. Yes, you are absolutely correct. We did some shopping. Volatility is something you can harness. If you don't have to be scared of it if you know what you're doing. So we did some shopping. We went after Apple. We went after Amazon. We went after NVIDIA. We went after some of the big players because quality companies never go out of style, and you can harness a dip if you need to.
John, let me ask you about kind of sticking with this whole psychology thing for a moment. Sentiment in general has been low. I find it ironic because individual investor sentiment came down a lot over the last few weeks. The pros still, they were more bullish. But overall, that's supposed to be a contrarian indicator. Is there a point, though, when everyone is sort of down in the dumps where it could become actually a self-fulfilling event for the economy and for the stock market?
Well, the stock market dynamics certainly are more driven by sentiment than the economy is, right? And so one thing investors need to do is take a step back, look at the real drivers of future sales and future profits of those quality companies. And when you look at the economy and its evolution, right, we are still in the middle of reopening. Certainly delayed, a bit postponed because of the surge in COVID right now. But ultimately, people are getting back to work. And they'll continue to do that over the next coming months and quarters. And so when you look at the fundamentals and you choose to own the companies that have growing sales, you'll continue to see an opportunity for investors to own these good companies that are going to be part of that reopening.
I apologize if I was talking over you a little bit. You were going in and out. I want to finish with you, Jack. Where do we go from here? Are we still in this state of flux? I mean, the gyrations are picking up. But you know, we look around, and it's not too long from now, maybe 2 days from now, we'll be back at an all-time high. I mean, is this still going to be the trend?
I think so. I mean, the fact is, it's all eyes on the Fed and this tightening program. And I think we got a taste of it yesterday when the minutes came out. Anything that could forestall that tightening will keep real rates negative for longer, low interest rates lower for longer, and that just continues to encourage risk taking, gold versus cash. So I think that I will say that if we look out 6 months, a year, we're going to have to deal with higher interest rates and a tightening monetary program. Right. All that means is, we have to focus on the tangible stuff, the earnings and dividends, and we can't rely on valuation expansion.
All right, back to fundamentals. Let's just rip this Band-Aid off once and for all, right? Let's get it over with. Jack, Joanne, Keith, thank you all very much. Well, one CEO admitting that...
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.